Welcome everyone, another great video. Janice gave us a great question. A
Mhm.
question like this we get frequently. How much do I need
Yes,
to get 10,000 a month in retirement? That's a fantastic
it is.
retirement. How do we get there? We assume Janice means 10,000 a month after tax, like actually the ability to spend
Yeah,
10,000 a month. We'll do a simplistic answer, then get into a little more nuance. Simplistic answer really just uses the 4% rule.
that's right. 120,000 is what's going on. You're going to need that every month or every year, should I say. So you're looking at $3 million just based on that 4% scenario. Now, it's not perfect, as we said, it's a rough guideline, and we're ignoring tax, as we mentioned. But if we take a look at the case study sort of scenario to do this, we'll say that Jack's 57, Peggy's 58. Now, of course, this is the case study we're dealing with. Both still working, retiring when Jack's 65. Now, they want 10,000 after taxes, as we mentioned, in today's dollars for retirement. So we're going to make a few assumptions on their ideas as well for their government scenario. So we're going to get maximum OAS, which is about $727 a month. Jack gets $1,000 a month for his CPP. Peggy's getting $900, and Peggy has a bit of a defined benefit plan that's going to pay her $1,500 a month. So those are our parameters. What does that mean we've got to deal with for money?
Yeah, and this is a common scenario. We're not doing outlandish numbers, a
No,
little
no.
pension, some CPP, some OAS. This would be a typical retirement, at least that we see.
Mhm.
And now the details here, we're building this up. CPP, OAS, they now have together as a couple between their CPP and OAS about $3,354 a month coming in. That's before tax.
Yep.
They also have that pension from Peggy, a small pension from prior work, about $1,500. So looking at $4,854 they already have coming in before tax every month from pensions. So if you're trying to get to 10,000 after tax, that's a pretty good start.
Yep.
Some of the other assumptions here, just so you understand the calculator, we assume they have no debt. When they get to retirement, that debt's going to be paid off. We're only looking at the retirement savings in the first scenario. We'll get to other options. We use the Maurer calculator.
Yes.
They assume 5.5% of earnings before retirement, 4.5 after, or pardon me, 4.25 after. We assumed Ontario tax rates and Jack going to 89. Again, that's the Maurer calculator free online. You do all of that, the outcome, they need to save about $2.1 million
Yep.
of their savings, and then they're getting a little bit pension, and then they could do that $10,000 a month after tax, adjusted for inflation, for all of retirement. You can already see pretty big difference here. That's 4%
Substantial.
rule. 4% rule by no means perfect,
No.
but it assumes 3 million. Now we are working in some pension. We're already dropped that number down to 2.19 less saved in order to achieve that. We'll go through some other options here quickly, but they have questions. How do they get answers?
You go to chatwithclintonandkevin.com, send the question to us. We'll answer you back as quick as we can. More stuff like this, and you're good to go. But yeah, I mean, if we take a look at some of those assumptions that we've done, as you mentioned, I mean, we've roughly reduced it by a third already just because of what they have from their pension side, which is phenomenal. But what do we assume if we deal with their house? Now, we assume they live in Ontario. We're assuming Toronto. So, they have a house that they're looking at 1.1 million, and they're looking at, say, 77. They want to downsize. They want to get a condo for $500,000. So again, you get $600,000 that you've now incorporated in cash that you can get there. Now, we're assuming that they're doing this later down the road. So if we put that money towards it, and we keep calculating the way we did, now we're looking at required savings that is reduced even further from that 2.1 to about 1.819. So again, we're reducing the number just because we're calculating what they're going to have later on in life, so they don't need to save as much right now to be able to get to that factor.
Yeah, so we're factoring in the house. We're saying eventually there'll be a downsize, 10 years into retirement, 12 years into retirement. In fact, in this case, well, how much do I need on the day of retirement, knowing there's going to be some house equity down the road?
Yep.
You can see that amount keeps shrinking as we factor these things in. Quickly, we'll mention if you like videos like this, we certainly love our newsletter.
That's right.
Comes out roughly weekly, once every week, every 2 weeks, with little financial planning tips. There's a link in the description if you'd like to sign up. Some important considerations here if you're building towards that $10,000 a month retirement. First takeaway here, the more pensions you have, well, the less savings you're going to need, as
Goes
is
without saying.
here for Jack and Peggy, but there's a few more.
Yeah, I mean, there's tax implications that you have to sort of look at. So Jack and Peggy can, of course, being a couple, they can split their income, which is really nice, as opposed to one person earning 120,000 a year. Now you're two at 60. Better tax rate, so you're not having to pay as much tax, which means there's more money in your pocket going forward. And of course, what we're doing with this whole scenario is we're looking at a $10,000 level forever. They're not changing it. I mean, traditionally, we've talked about a retirement smile where you go up and down. We're just saying 10,000 from the beginning of retirement all the way till they die. And that's going to give us some more unique planning situations. But that always leads us to one thing that you should always need to do.
Yeah, you want to plan based on your unique situation, your unique circumstances and goals, and that can factor all of this in to see what would be achievable. You mentioned retirement spending.
Yes.
Frequently, it's not level. In fact, the data shows us
No.
the exact opposite. You got a great video talking about how much will I spend in retirement. Click on that one. We'll see you again very soon.
Take care.